Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Brookdale Senior Living Inc. quarterly report. Brookdale Senior Living Inc. offers a wide range of businesses and services catering to the senior living community in the United States. At its core, the company operates three primary segments: independent living, assisted living and memory care, and continuing care retirement communities, CCRCS. The independent living segment provides housing for middle to upper-income seniors, offering independent and assisted living units within a single community. This segment is designed to cater to seniors who value their independence but may require some assistance with daily activities. In contrast, the assisted living and memory care segment offers 24-hour assistance with daily living activities in freestanding communities. These communities are specifically designed for residents with Alzheimer's and other dementias, providing memory care services tailored to their needs. The CCRC segment is perhaps the most comprehensive of Brookdale's offerings, providing a range of living arrangements, including independent and assisted living, memory care, and skilled nursing. This segment caters to seniors with varying levels of physical ability and healthcare needs, offering a continuum of care that accommodates their evolving requirements. In addition to its operational segments, Brookdale also manages communities on behalf of others, further expanding its reach and influence in the senior living industry. With its headquarters in Brentwood, Tennessee, Brookdale has established itself as a leading provider of senior living services across the United States. Brookdale Senior Living Inc. maintains a market capitalization of $3 billion, broadly in line with the industry peer group. Brookdale Senior Living Inc. trades at a lower price-to-book ratio of -55.47 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 101% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline are multifaceted, reflecting both positive and negative trends in the company's financial performance. Revenue growth is primarily driven by an increase in management fees, which rose by a significant 105.1%. Additionally, reimbursed costs incurred on behalf of managed communities also contributed to revenue growth, increasing by 9.6%. The sale of 7 communities resulted in a net gain of $4,034,000, further boosting revenue. Furthermore, private pay revenue increased from 93.9% to 94.4%, and same community RevPAR saw a 3.9% increase due to higher occupancy and average revenue per occupied room. On the other hand, revenue decline is attributed to several factors. The decrease in resident fees, primarily due to the disposition of communities, accounted for a significant -9.2%. The sale of non-strategic or underperforming owned assets or leases also contributed to revenue decline, with 7 communities sold and 2 disposed through lease termination. Furthermore, the planned sale of 19 additional owned communities in 2026 is expected to impact revenue negatively. The net income of the company underwent a significant change between 2025 and 2026. In 2025, the company reported a net loss of $64.9 million, but this decreased to a net loss of only $6.9 million in 2026, marking an improvement of $58.1 million, or a decline of 89.4%. This change can be attributed to various factors such as cost-cutting measures, increased revenue, or reduced expenses. In addition to the improvement in net income, the company's profit margins also showed a notable increase. The profit margin rose from 3.6% in 2025 to 6.8% in 2026, indicating an enhancement of profitability. This upward trend suggests that the company has become more efficient and effective in managing its costs and generating revenue. The company's financial performance indicates a strong ability to generate cash from its core operations. According to the data, the company has consistently produced positive operating cash flow in both 2025 and 2026. In fact, the net cash provided by operating activities increased from $23,402 in 2025 to $20,887 in 2026, demonstrating a stable and improving trend. This positive operating cash flow is a significant indicator of the company's financial health, as it suggests that the business is generating sufficient cash to cover its expenses and invest in growth initiatives. The fact that this trend has been consistent over 2 years further reinforces the company's ability to manage its finances effectively. Overall, the data suggests that the company is well-positioned to continue generating positive operating cash flow in the future. The company's debt level has undergone significant fluctuations over the past year. While the current portion of long-term debt increased by $5,124, the total liabilities actually decreased from $5,995,620 in 2025 to $5,952,383 in 2026. This suggests that the overall debt burden on the company may have been reduced despite the increase in certain components. However, a closer look at the data reveals some inconsistencies. The long-term debt, less current portion, increased by $9,364, which could indicate an increase in the company's long-term obligations. Furthermore, the outstanding mortgage notes payable remained unchanged at approximately $3.9 billion as of both March 31, 2026 and December 31, 2025. In terms of interest expenses, there is a clear decrease from 2025 to 2026. The interest expense decreased by $1,946,000, 3.67%, and by $5,479,000, 8.4%, indicating that the company has managed to reduce its interest payments over the past year. This reduction in interest expenses may be attributed to various factors such as refinancing or changes in debt composition. Overall, while there are some discrepancies in the data, it appears that the company's debt level and interest expenses have undergone significant changes over the past year. The decrease in total liabilities and interest expenses suggests that the company has made efforts to manage its debt burden and reduce its financial obligations. The performance of various segments within the company has been analyzed, revealing both positive and negative trends. The independent living segment stood out with a notable increase in operating income of 20%. This growth was also seen in the all-other segment, which experienced an impressive surge of 105% in operating income. In contrast, the assisted living and memory care segment maintained relatively stable operating income. However, one segment that struggled was CCRCs, continuing care retirement communities, where operating income decreased by a significant 4.5%. This decline highlights areas where the company may need to focus on improvement strategies to reverse this trend. Overall, these results indicate that while some segments are thriving, others require attention and investment to achieve optimal performance. Management's outlook for the company is centered around strategic growth and financial discipline. One key area of focus is the sale of non-strategic or underperforming assets, with plans to sell 19 additional owned communities in 2026 through its capital recycling program. This move aims to improve the company's overall performance by eliminating unprofitable investments. In addition to asset sales, management is also prioritizing revenue growth and cost control. The company seeks to increase revenue per available room, RevPAR, while maintaining a disciplined approach to expenses. Furthermore, management plans to refinance or extend maturing debt and evaluate the capital structure to ensure optimal financial stability. To achieve these goals, management may need to explore alternative funding options, including issuing additional equity or debt securities. However, this could potentially dilute existing shareholders' ownership percentage if not executed carefully. Overall, management's strategy is focused on driving growth while maintaining a strong financial foundation for the company. That concludes the financial summary for Brookdale Senior Living Inc. feel free to comment below, and I will be happy to answer them when possible.